Welcome to the Daily Shareholder Brief. Today is February 23, and we are looking at companies where a clear narrative overhang exists, valuation has compressed relative to fundamentals, and there is a definable catalyst path. We will cover 6 companies: Adobe, Nike, Charles Schwab Corporation, LVMH, Roche, and Samsung Corporation. As always, this program is for informational purposes only and is not an investment advice. Always do your own research and consider your individual financial situation before making any investment decisions. So let's start with our first company, Adobe. Adobe is a software and digital media giant. Adobe has declined 44% over the last 12 months and is trading at 52 weeks low at a PE of around 15. Its forward PE is 11x, is well below the historical 5-year average of its software peers of around 25 to 30x. It is also trading below multiple fair value models. Some discount cash flow models imply a 40 to 50% upside. Yet, analyst after analyst have decreased their price target for Adobe. The market sentiment for Adobe is so low that it has compressed its multiples to levels more typical of a cyclical or a low growth firm, despite the persistent recurring revenue and strong cash flow conversion. The market narrative is extremely fearful of AI's impact on Adobe's Creative Cloud business and is overly discounting Adobe's AI monetization and Creative Cloud pricing power. Is AI skepticism causing the market to misprice a secular software as a service cash generator? Adobe reports its earnings on March 12, and we will see what the company has to say about its EPS this year and the next. If the company is confident of its growth, it leaves room for multiple expansion. Our second company today is Charles Schwab Corporation, which is a financial and wealth management company. Charles Schwab stock grew a healthy 15% over the last year, but has declined about 10% over the last 4 weeks. In terms of its valuation, Schwab currently trades at forward PE of 15x. It has revenue growth of about 18 to 22% year over year. It has strong net cash position. It has about 34 billion in net cash after deducting a debt of about 50 billion. So here's a company with a strong revenue growth whose valuation has experienced significant compression due to concerns around interest rates, net interest margins, and banking stress. This fear-driven multiple contraction fails to account for normalized earnings power once interest rate volatility subsides. Asset gathering and share buybacks support earnings per share growth, suggesting upside beyond cyclical pressures. So the market is pricing Schwab for enduring bank-style stress, but considering its free cash flow and earning stability, the stock could be undervalued. Our third company today is Nike, which is a consumer and a brand leader. Now, here is a company that was a leader in the consumer products category and lost its way after COVID growth. Today, it is a turnaround story, and although the stock is down about 60% from its highs in 2021, it is not a brand that is out of the woods. In spite of experiencing a revenue contraction, Nike currently trades with a rich forward PE of about 39 to 40x, driven by investor sentiment and stock buybacks. The main mispricing thesis for Nike is that its inventory overhang and China growth concerns have pulled future multiples lower, but Nike's pricing power, digital transition, and direct channels suggest earning resilience. So if Nike can get its revenue growth in control and manages to control its debt, it could once again experience a resurgence reminiscent of its early days. Our first European company today is Louis Vuitton Moet Hennessy. LVMH is a luxury goods powerhouse that has been marred by stock price volatility over the last year, having declined in early 2025, surged in later 2025 to once again experience a decline in 2026. Today, the stock trades at a PE of 25 due to disappointing recent financial results, particularly sluggish sales growth, declining profits, and a cautious outlook from the company, signaling a broader slowdown in luxury market, especially in China, and concerns about economic uncertainty, strong euro, and US tariffs impacting luxury spending. The company trades today at a forward PE of 24 to 26x. It has a modest low single digit revenue growth and a net debt of about 23 billion. The question about LVMH is the market discounting luxury too much due to China or Asia slowdown fears? Premium brands with structural pricing power like LVMH can support resilient margins that arguably deserve higher multiples than currently discounted. Our fifth company today is Roche, the healthcare pharma behemoth. Roche is currently trading at a forward PE of 18x. The stock has experienced a 44% growth over the past 12 months despite a modest revenue growth of around 7%. It has a $22 billion net debt. So what is driving the interest in Roche? Company recently reported that it will have up to 19 new medicines to launch by the end of the decade. Besides its experimental breast cancer drug giredestrant and multiple sclerosis treatment fenebrutinib, Roche is betting big on a slice of lucrative obesity market in the coming years when it reported the phase 2 data of its weight loss candidate CT388, which showed a 22.5% weight reduction over 48 weeks. So at the moment, Roche may be lumped with low growth pharma multiples due to a patent cliff anxiety and diagnostic headwinds. Its pipeline in immunology and oncology and balance sheet strength suggests a disconnect between pricing and long term earnings durability. Our final company today is Samsung Electronics. This stock is a difficult stock to invest for American investors as Samsung is not traded on NYSE or NASDAQ. However, one can invest in Samsung through pink sheets or by investing in a Korea ETF like iShares MSCI South Korea ETF. Samsung stock has experienced 236% growth over the past 12 months and currently trades at a PE of 29. Still, it is trading at a forward PE of 9 to 15x, pointing to significant growth potential. Samsung reported a 23% quarter over quarter revenue growth recently, and it has a net cash position of 100 trillion won. So, what is driving the low Samsung share price? Samsung may be suffering from memory chip boom and bust cycles. Massive capital expenditures on new factories often leads to oversupply, causing prices to crash and hurting stock prices. However, industry data shows a shift to supply shortage. When this happens, prices for memory jump and profits increase quickly. The need for high performance memory for AI servers is creating a massive new long term demand source that is different from previous consumer led cycles. This could lead to a significant expansion in earnings multiple. So, to summarize today's companies, in case of Adobe, AI skepticism may be compressing the SaaS PE multiple. In case of Schwab, rate volatility is perhaps being priced as a structural risk. In case of Nike, near term macro fears may be discounting the brand strength. For LVMH, China's slowdown may be over discounted. For Roche, pipeline growth may be underweighted. And for Samsung, the AI demand could potentially drive significant future growth, which is currently being discounted. This concludes today's daily shareholder brief. This program is for informational purposes only and is not investment advice. Always do your own research and consider your individual financial situation before making decisions. Join us tomorrow for another structured look at companies that are shaping global markets.